Hello, everyone, and welcome back to 4C Markets. I have my co-host with me, Serhii. Serhii, you can introduce yourself, please.
Hello, everybody. This is Sergey, and today on this podcast we will have pretty interesting topic to discuss: is how actually the portfolio is being built. And Alejandro, can you tell the audience how exactly, like in old times, portfolio managers were selecting the assets as it becomes a portfolio for the clients?
Yeah, it's a really interesting topic to get into because before the age of machine learning and artificial intelligence, when a portfolio manager wanted to go and select assets, they were limited to the window of assets that they could study within a certain threshold, right? I remember, back in the day, we used to talk about like the Bloomberg terminal, which is very important, but now we're not limited to tools like that, which are very expensive to acquire. Instead, you're able to go into the market, look at the information that you have, and apply machine learning and artificial intelligence algorithms to it that will allow you to automatically select portfolios that are very likely to perform well against benchmarks, which will allow you to safeguard your assets and even beat the market.
Oh, this is interesting. And for example, for the users to understand how big is the universe of all assets that can be traded. So is it like thousand? Is it like hundreds of thousands? Is it the millions?
Oh man, yeah,
Because
that's such an interesting question because you know, you have companies that are traded in many markets around the world. So you have like the Japanese Stock Exchange, the United Arab Stock Exchange, the London Stock Exchange, and of course the United States Stock Exchange, which is the one that I concentrate on. So when you are trading assets, if you are going to be trading one asset for another, you have to try to make sure that the assets that you're trading are not going to be affected by currency fluctuations. So if you're trading assets in Turkey, and you are also trading assets in the United States and you're trying to profit from both, well, you have to ensure that you also account for currency fluctuations between one currency and the other. But if you're trading with currencies that are pegged to the United States dollar, like what happens in the United Arab Emirates, then you're able to, for example, invest in some assets in the United States and other assets within the UAE. And when you're trying to do your currency conversions to see if one is performing better than the other, you only have one rate that you're going to be exchanging, right? That means that if you're buying, for example, parking in the UAE, and you're buying a similar company in the United States, which also handles parking and other things of the sort, you're comparing the two, you would only have to do a quick exchange rate of like 3.66 in order to get an equivalent ratio, right? So you wouldn't really have to continually try to compensate for currency fluctuations when you're trading between these two. Point is like try to keep your universe in a way that you understand it. Try not to like dabble so much that you like overspread yourself and then you don't know what you're buying.
yeah, but at the same time, like if you assume that there is like 60,000 of companies entered the IPO in United States only, and probably like hundreds of thousands like penny stocks and probably millions of derivatives. So
Oh
for
yeah.
one single person, it's still impossible to even like to comprehend the size of the markets. Not
Yeah.
I'm not talking about even how to analyze this. So basically, you have to have some filtering rules how to narrow this down. So can you explain like your narrowing the rules? What exactly you're looking at? Like how do you select your blue chips to get started construction as a
Yeah.
portfolio risk?
So what happens when I do it? I go ahead and I choose companies utilizing tools that are already available to understand the market capitalization of these companies. And the market capitalization basically tell us what does the world of the market, what do people who are buying these companies want these companies to be worth, right? How much are they willing to pay for it? You take that, you multiply by the number of outstanding shares, and boom, you get the market capitalization of the company. What I have noticed, and this is something that can be argued, but what I have noticed is that when companies go above a $400 million threshold, they start to become very interesting to look at, right? Before this market capitalization happens, you don't really get to see too much liquidity as a whole when you're comparing one company to another. But once you cross this number and you have good liquidity in the company and you have a lot of outstanding shares, you start to notice a pattern that there's a lot of trade and liquidity, which means that if you hold a company that is a liquid asset, you're also going to be able to sell this company, right? So you're not going to be stuck with it as it goes down because nobody wants to buy it from you. And the magic number for me is 400 million, right? That's the number that I have come to understand that fits the profile that I'm looking at. On top of that, I go ahead and I look at all of the companies that are available, find these ones that are worth 400 millions, look at all of their financials, and then decide that these 3,100 companies that I started with are worth studying more. That doesn't mean that I'm going to invest in all of them. It just means that I'm going to be studying them to see which of those I choose to do my investment at the time that I build the portfolio.
Wow, this is impressive. But at the same time, 3,000 companies, like to study 3,000 companies, like all fundamentals, it's like a huge work. And
Oh
as soon
yeah.
as the market is dynamic, so it's not possible to do within like one day or even like 1 week, but you need to constantly update the portfolio. So can you show the screen and show the process, how exactly your AI system constructs a portfolio from all of this? Like which dates are you looking, like how you benchmark, how the selection process goes, and so on and so forth. So this is
So
actually the power of AI, where it can look through the very wide
yeah.
universe and select it for you.
Okay. So trying to show all of that is gonna be, very, very overwhelming. So what I'm gonna do is I'm just gonna show like a quick filter of what happens. So as I mentioned earlier, we started with a universe of 3,100 companies, and our allowed stocks dropped down to 127. That means that the system went through and it said from these 3,100 companies, after studying the fundamentals and after looking at the market capitalization and their liquidity, I suggest that you invest in these 127 companies. And so then what happens is that the system starts trading them, right? So this portfolio was built back in November 13th. And as I mentioned earlier, we started with 127 allowed stocks. But in total, we were allowed to continue to view 162 because sometimes some of them exit and sometimes some of them re-enter, right? So our allowed stocks, 127, was what remained after we had filtered down to 162. So this is a huge filtering process that happens through the algorithm, right? Then what happened when we did this is that an initial portfolio of $1 million became 1,624,000 from um, November 13, 2023, as we did daily trading until today. You know, and so this is what the power of automation can do for you. When you have such systems in place that allow you to know what you should be choosing, and this actively keeps tabs on the market, then your automated portfolio becomes your broker. So that's how this one works. And we're also going to be showing numbers and other things to further highlight how this portfolio performed.
Yes, Alejandro, this is pretty interesting. So can you show the comparison plot to see how actually the graphs performed?
Yeah. So as you notice, first I just want to talk about this a little bit. The portfolio ROI, when it first gets started, the portfolio needs to learn, right? So it has to see whether or not it's going to outperform the S&P 500. And we notice that time passes before the system starts to outperform the S&P. So once we get to enough learning on the portfolio, that's when we start to see the performance going up. So if we go all the way to the end of the portfolio, we see that this gives us a 62% return, while the S&P 500 only gave 46%. So what does that
So
mean?
we are outperforming the market. This is
We are
very cool.
outperforming the market, correct? So if we look at the plot here that we created, when we started, we were underperforming the market. Then we started performing with it, and then we outperformed it on times of huge volatility. So this is why we need to actively ensure that the portfolio is doing what we want. Our automated portfolio is the blue line, and then the S&P 500 is the orange line. If you had simply allowed your money to ride on the S&P 500, most of the time you would have been making the same returns, but you would have had huge losses right here, right? And then again here, when things rebound for the S&P 500, you were still very, very, very profitable, but because of the huge growth on the S&P during this time period, while the market was not really losing money, as you see, it stayed in the positive most of the time. you are not making as much as the S&P. So what is the take from this? An automated portfolio with automated trading will perform better, and it will also allow you to take in bigger profits as a whole. But if you rely solely on it, you're gonna lose out on potential earnings, right? Like I remember when I was managing this portfolio and I started looking at how it started to shift here, I switched it, but I allowed the automated portfolio to continue running. But I did notice that it was underperforming the S&P. So that's why we have the other videos that show how we switch between assets when we see that one portfolio is not performing as well as the other. But for full transparency, we wanted to show how one portfolio can outperform the other, especially during volatile times. And this is what a machine learning algorithm is really, really good for, especially in peaks like this one, where you're having such nice performance and then all of a sudden the market drops. While this is trying to recalculate, it is still saving your assets, right? It's not allowing you to lose the momentum that you have. But then there's days like this when everything just drops at the same time and the market is not fast or the portfolio is not enough fast enough to catch it. What does it mean as a whole though? As a whole, we started with a portfolio worth $1 million and we ended up with a portfolio worth $1.6 million with a 62% return. If we simply would allow the money to stay in the S&P 500, we would have missed out on approximately 18% of profits. What do you think, Serhii?
Yes, this is like pretty interesting, amazing work because to outperform the market, I think it's like really, really hard.
It is difficult. That's why you have to diversify and you have to diversify, you have to rebalance, and you have to continue to watch the market. And you have to be active on it, right? Like, don't just simply put your money on the automated portfolio and let it ride forever. You have to rebalance, pay attention to it. You don't want to lose your money or your client's money.
Yes, but at the same time, like, in all business schools, it's like been taught that it's very hard to outperform the
Mm.
market. But what you are showing that during the volatile times, the market has capabilities, that there is potential that our portfolio can outperform it. And
Oh
this is
yeah,
really, really
well,
cool.
and it's just a lot of times it's just common sense. Like when you're trying to do your investments, because for example, we have our save assets portfolio, which we've been tracking for a while. So if we look at the way that it's been performing, this is what we purchased on March 2nd. And if you notice the difference, as the S&P 500 has been dropping, because this is negatively correlated against the S&P 500, this one has been outperforming it, you know? So that's what's really important, that you pay attention to what's happening out there. A computer or an artificial intelligence, they can process information really fast, but they don't necessarily know what it is that needs to be accomplished or what will happen. So if you watch the news to say that a war is starting, um, unless there's rules in place to tell your AI that if it hears the word war, move to these assets, it's not gonna know to do that, right? But you as a person, you have this knowledge, so you can do things like this.
Yes, just track the dependencies and go after money and after value chains and see where it leads you.
Correct. And that is what we wanted to record today. So with this, we leave you with the knowledge that there are always places to put your assets in order to keep them safe and in order to watch them grow. And if you have the tools available to you to invest in a way that is smart, um, do so. Use the tools available to you. This channel is here to answer questions. So if you have any questions about this video, leave us your comments, press subscribe, and we will see you next time.